Let's bring in Danny Moses of The Big Short fame. He's founder of Moses Ventures. Danny, there's so much to unpack here with you that I want to get to. But first, I'm just curious what you think of this bank bounce, and are you finding any shorts or longs in this sector at this point?
I'm kind of taking it all in here. A lot has gone on, obviously, in the last week. A week ago, no one even knew, or some people knew this might happen, but this kind of new. So it's hard to really buy or sell securities, or stocks that is, not knowing how the plan's going to be unveiled. And we're getting a little bit more clarity on that in terms of this BTFP, which they could have called BTFD, obviously, if you know what I mean, in terms of what they're going to be providing. And so the problem here, though, is really sifting through. It's not just about agency securities and treasuries. There's commercial loans that are on banks' balance sheets, commercial real estate, right, C&I loans, et cetera, that are still going to be a problem. And I think now's the time to really dig in to these banks. So,
yeah, there's a lot of work to be done. To think that people whose sole living is to analyze these banks, whether it be Wall Street analysts, ratings agencies, San Francisco Fed, regulate, you name it, they all missed the boat on this. So for all of us here out here, there is a lot of work to be done. In terms of, though, guaranteeing all deposits, does that make anything safer in your view? If this became the norm, if this became the rule, that there is a backstop for everything, does that make the sector any more attractive in your view? Stabilize things?
No, I think that should scare people, the fact that the regulators think that they need to go out and actually do that. And so now I think what we're going to see is the banks that maybe come to this window and use this program is going to raise a lot of questions. And you can't assume that the regulators have any idea what they're actually dealing with now, considering that they were completely caught off guard, it appears, by what just happened at Silicon Valley Bank. So that should make people nervous. But again, the first earnings out of the gate that we get for Q1 are the banks. So we're going to see a lot of interesting information come out. So we're definitely not out of the woods. And I think the Fed is kidding themselves if they think that this situation is just going to go away. I think a lot more people will come to this new window, so to speak, to deliver some of these assets.
Hey, Danny, it's Tim. So let's get to, I feel like the Fed and the dollar and even rates were kind of the previews, and we're now at the matinee. It's credit time. And to me, we may have peaked on Fed. We may have peaked on dollar. We may have peaked on rates. This is generally a great time for owning equities, but we've just gotten a glimpse of what goes on in credit. How are you playing that? How do you view credit spreads here? We went up a full 1% in about a week on high-yield OAS. I realize it's not, at extreme levels, but everybody says there's no credit dynamic working right now. I'm not sure I agree.
There's been a credit dynamic in place since the Fed started raising rates. We're just now getting the lag impact of that. Look back in the last fall when Blackstone had to gate their funds, when Starwood had to gate their funds. That's really on the commercial real estate side of thing that's been occurring. You had two defaults already, right? PIMCO, Brookfield, already, defaulting on office buildings. These things have already been in motion. And this is what I mean about, okay, we didn't see this coming a week ago, or 99% of people did not see this coming. So now it's the all clear. I don't think so. To your point, Tim, you made earlier on the show about cost of capital moving higher, rest assured that banks now will be forced to have more capital. And like it or not, the big banks are about to get bigger. And it's been happening in real time as we're sitting here. It's probably happening right now. And so that is not what the regulators wanted to see. But to your point, it doesn't change anything. What it did was it basically moved the Fed from a terminal rate or market expectations from almost, it had gotten high as 6% here, really to 5%. And now at the end of the year, I'm looking on CME and Fed Fund futures are at 4% at year end. So what we did was we got the relief rally associated with the Fed stopping. But the truth is, the aftermath of this, I think actually the economy, if you believe it's going to slow down, it just accelerated that slowdown because banks have to really pull back in their activities.
Danny, so, the saying is the Fed keeps going until something breaks. Was this it? Where
I think this was a small vase sitting on the window. So again, what I really think is in terms of breaking, obviously this wasn't on a lot of people's bingo cards, right? It was on certain people that have been actively shorting some of these names that saw this balance sheet that had massive issues. So I just really feel like we still have underestimated in this market in general what is happening when you raise rates 4.5% and what may end up being 5%. We'll see what the Fed does next week. Maybe it's another quarter point. And the other thing, Melissa, is this whole QT, quantitative tightening that's been going on. Great job. We got it down from $9 trillion to $8.4 trillion. I think we can safely say that the QT is probably done here, and we're back in somewhat of a QE, at least a neutral mode. So we got some stuff done, but the problem here is we still have inflation, And I believe that you are now brought forward the potential for stagflation as a result, because the Fed still has to do their job, because what you don't want to see is them to stop while inflation is still running hot.
Yeah, it's a tough choice. Financial stability versus price stability. It's a tough one. Danny, it's always great to speak with you. Thank you so much. Danny Moses.